What's next for markets?
I'm Michael Kantrowitz, Chief Investment Strategist at Piper Sandler, where I lead the portfolio strategy team, recently ranked number one on Wall Street in the 2024 All-America Institutional Research Survey. How resilient is the U.S. consumer? In today's episode of What's Next for Markets, we speak with a 20-year veteran on Wall Street, senior analyst Peter Keith, who covers consumer stocks in the hardline and broadline industries at Piper Sandler. In this insightful conversation, we explore consumer behavior through the lens of Peter's proprietary mattress sales index and its implications for the broader economic landscape. The discussion highlights key retailers such as Home Depot, Lowe's, and Wayfair as bellwethers of market trends in housing and sheds light on the challenges and opportunities in the market. The discussion further explores the impact of tariffs on the consumer and which retailers are most at risk.
Peter, thank you so much for joining us today. I'm super excited to talk with you. Your coverage universe on the consumer, specifically covering the hard lines and the broad lines, is so interesting because it's really these bellwether names that you look at that are Home Depot, Lowe's, Wayfair, that are so at the tip of all of these major trends that while some of them may not be the largest part of the market, are such an important part of the market and a driving force behind a lot of the stuff we do in the macro space. So I think this is going to be a really interesting conversation. There's so much for us to talk about today. I wanted to kick it off with one of the more interesting things you do, which I love because it makes so much intuitive sense. And that's our team motto of question everything and then look for things that make sense, because then they're actually probably more likely causation than correlation. And the thing I'm talking about is your mattress index. Can you tell us a little about that and give us a little background there?
I would like to say, too, Michael and Stephen, it's been great working with you. We've teamed up with Piper Sandler buying Cornerstone almost exactly 3 years ago. And having been on the sell side for 20 years, I've been a much better sell-side analyst having you guys as macro partners. As a fundamental analyst, trying to do our own macro work, which is dangerous. It's really been great having you guys part of the Piper platform. We draw up a lot from your macro work that makes us smarter. On that, we try to have our own macro indicator, which is the mattress survey that I've done for 9 years now. And just to give you some background, we've built it up to be about 15 different retailers across the country that would sell some mattress only, some furniture and mattress stores. These are large chains. They can range from 10 stores all the way up to about 150 stores. So in aggregate, 15 retailers, I think there's around 500 to 550 total stores across the country. And we asked simplistically what were your mattress sales year over year. And we've been doing this every month for 9 years. And we started because it would make us better in covering the mattress space. But we found that mattresses are very much the tip of the spear on the consumer. And what I like to say is really mattresses are the single most discretionary and deferrable purchase that a consumer can make. So that's why it's the first in, first out when you think about like a downturn or recession. And the reason why is mattresses are big ticket by nature. And then secondly is mattresses don't break. There's no broken refrigerator or something like that where you have a natural duress. So a mattress doesn't ever break, and a mattress never embarrasses you, right? So it's not like you're having company over and you could get a new TV or a couch. Mattress is largely upstairs in somewhere in your apartment covered by a sheet. So it's all, and also mattresses tend to have a little bit longer purchase cycle. People do some research, and it can be anywhere from a week to a month. Bottom line is that when something happens in someone's life, it's just a very easy purchase to say, I'm going to hold off on buying this. And so it's where we see very sharp changes over time when there's changes in the economy or maybe a war breaks out and you hear a CNN effect. And so what most recently really caught my attention is that mattress sales have been under significant pressure for the last 3 years with the whole stay-at-home bubble kind of popping and people moving, doing more services and going on vacation, going to restaurants, not buying goods. So that's all well and good. It's been tough 3 years. But we started to see normalization really after the election, where mattress sales, furniture sales too, were starting to stabilize. And we saw January was actually a very strong month, like the strongest month in mattress sales in like 3 years. So we're like, okay, here we go. This is 2025, where mattresses are coming back, home buying, at least home related purchases are coming back. And then we get to President's Day weekend. And mattresses are very popular around these 3-day weekends. The industry, but once you're aware of it, you'll see a lot more. There's a tremendous amount of TV advertising, radio advertising. If you're just aware of it, you'll notice it when you going into and coming out of a 3-day weekend. There's a lot of promotions. Mattress industry can oftentimes be what you call like peaks and valleys, and peaks seeing these 3-day weekends. So anyway, we did a lot of checks with retailers coming out of President's Day weekend. I thought it was going to be great. And in President's Day weekend, it was a disaster. But pretty much everyone I talked to was disappointed, and where sales were down. We penciled in an estimate of down mid-single digit, and that's after January was up mid-single digit. And that really got our attention. Something has changed here with the consumer that this didn't make any sense. And there were some excuses around weather, which was fair. Some areas got snow over President's Day weekend, Northeast being a good example of that. But I go back to January, I was talking to retailers. Remember, like the Southeast had a lot of snow. There's like snow on the beaches of Florida. I was talking to retailers in Florida, and they were like, yeah, it didn't matter. We shut our stores down for 2 days, and we reopened, and we're bouncing right back. That wasn't the case. February was like, no, we got pummeled by snow, and it's still just really sluggish. So it was a bit of a yellow flag, even more of a red flag. Like something's changing here with the consumer. And then I think what we've come to learn is that it wasn't weather, and there was been a lot of policy changes by the new administration, and that was causing for some people some anxiety and some hesitation. And we've subsequently seen a lot of companies talk about a sluggish start to Q1. So we'll continue to watch mattress sales. I'd say we still have to wrap up the month, but the conversations we've had in the industry is that the February trend, which all in ended up down 9%, like one of the worst months in a year, that trend has continued in March. So this is a leading indicator. It does suggest the consumer is still very hesitant on some of these big ticket purchases.
Interesting. You got me thinking, I don't see those commercials anymore for 1-800-mattress, leave off the last S for savings. Is there any savings anywhere? I'm curious in terms of pricing. Obviously, we've seen a lot of inflation over the last few years. Given what you said about the demand being quite weak, as we've seen in a lot of housing related items, is that an area where pricing has gone up a lot?
Yes and no. So there was inflation obviously in 22 and a little bit in 23. So the industry did pass through some price increases. But what you've seen over the last really 10 years, and maybe COVID accelerated, is that more and more people are just buying mattresses online. And that's why you would see something like 1-800-mattress go away, because they're not, unless they were able to pivot to more of an online model, they've become somewhat obsolete. And so no one's going to buy a really nice mattress online without trying it. The idea of buying a mattress online is that you're spending just a couple $100s. You need maybe something as a stopgap or temporary. So a lot of the share has moved towards Amazon with kind of non-branded mattresses that cost less than $500. So that has put pricing pressure on the whole space and pressure retailers, because Amazon has taken a lot of share.
Interesting. This obviously dives into one of our favorite sectors in terms of when we're thinking about where we are in the business cycle and the market cycle, and that's our HOPE framework, which is an acronym that stands for housing, orders, profits, employment, how we see the cycle of the economy progressing when things accelerate and decelerate. And while this debate over the last couple of years between how the economy is going to land, hard landing and soft landing, in our work, we look for a landing, whether it's after a recession or after a slowdown and a soft landing. In the housing data, I guess this mattress indicator is certainly not giving us more conviction that the economy is close to landing quite yet. So how are you seeing that activity with respect to the other housing related names that you cover, from Floor and Decor, Home Depot and Lowe's, Sleep Number I see you cover as well, which obviously is another, I guess, mattress company. Maybe it's a tech mattress company. So I'd love to hear some more thoughts on how connecting those dots to the broader housing story.
Yeah. And so you look at the fourth quarter, and housing looked like it was starting to stabilize and maybe make a bit of a comeback. You saw home sales were up year on year, and that's probably the best indicator. And then the companies like Home Depot, Lowe's, Floor & Decor had good fourth quarters. It came in better than expected. But all three of those companies, when they reported their fourth quarter results in February, and it was generally kind of late February, all said been a little choppy as of late, and we think it's due to weather. And so that when I'm listening to this, and we had already done some of this mattress work, we're like, I just don't know about that. That doesn't sound right. And I think the companies then, these same companies got out to see the conferences, to see investors. That was a theme we were hearing about. There were at competitor conferences, and companies by mid-March were like, big ticket's a little choppy, big ticket's weak. We have subsequently seen existing home sales flatten out. They were down a little bit in February. I think if you extrapolate the February trend, we're probably going to remain flat to down. So there has been, I guess, I would say some backstepping within the home buying, the home remodel market is what it feels like. And all the consumer sentiment and confidence metrics have all been pointing negative now for the last 2 months. And that certainly that's going to impact consumers' mentality around not only big ticket, but also maybe even buying a house or holding off.
That's really interesting. So you also cover a bunch of other names that are anywhere from really discretionary goods, perhaps like Best Buy, and to things that are more focused on the lower income consumer like Dollar General, Dollar Tree. Are you seeing any different patterns there? I guess our view is of the world, and particularly the consumers, that it's been extremely bifurcated. We were talking about this earlier this week with you. And something I'm always trying to think about is, in terms of that bifurcation, are we seeing it converge, or are we seeing the weak getting weaker in this backdrop? I guess, what can you see from there? Are we seeing trade down? I think the aggregate story on the consumer is less interesting than what's going on under the surface. And I think you have such great insight into that from the names you cover.
Yeah, it has been a really interesting earnings season. I know you guys use the phrase K-shaped recovery, which I agree with from the last 2 years. The names like the dollar stores, that could be like a Dollar General, Dollar Tree, had a really kind of brutal run here with really disappointing results, challenged same-store sales, huge underperformance of stock prices. And then you have other names like a Williams Sonoma or an RH, even like a Tempur Sealy, like the Tempur-Pedic line, which is the high-end line, has done phenomenally well. So a lot of these higher-end retailers, higher-end brands have been fairly strong. Low-end's been weak with inflation. When you look at this most recent round of earnings, and it's more around like how companies are talking about February and March. And what you've seen is almost a complete 180 shift. So the dollar stores, one of the Dollar Tree just reported on Wednesday this week, Dollar General was last week. Both had perfectly good quarters, as slight beats, and they just talked about very steady trends into Q1. And we're now a month and a half, it's almost 2 months into Q1. And both companies talked about they believe they're starting to see trade down with middle and upper income consumers coming into their stores more. They like to use the phrase trade in, which is, I think, probably better.
Sure.
But Wall Street does use trade down. That's not something they were seeing. If you think about 23, 24, that's why their results were so challenged. Their lower income consumer was shopping less, buying fewer discretionary items, and upper income, middle income wasn't going there. So you're starting to see that shift from what they say. Now, it's still very early, but when you look at some of the consumer sentiment data from University of Michigan, and this Michael talked about going under the hood a little bit. Michigan survey breaks out consumer sentiment across 3 income terciles, upper, middle, lower. And the last 2 months, you have seen upper income sentiment decline faster than middle and lower income. And the combined February and March drop for upper income, it's one of the biggest drops in 15 years. So it has been a notable downshift. And I would like to say 1 month doesn't make a trend. So we saw it in February, but now we've got 2 months of back-to-back data where UMich and then the government's consumer confidence index has also declined. So if I were to summarize it, it feels like the lower income exposed names are steady, almost like they're getting more customers now. And I think the rate of change is faster with upper income, where that's been strong and you're starting to see some shakiness or some slowdown.
Interesting. So looking at your universe, you cover Walmart and Target. Is that people that shop there, do they trade in to a dollar store? Is that a risk to some of those companies, or is it just perhaps you get just a parallel shift down? So maybe some consumers that typically didn't shop at Walmart and Target will trade into that.
Yeah, it's possible. We go back to the Great Recession. The dollar stores were huge beneficiaries of this sort of trade-in dynamic, and Walmart struggled during that period, Target as well. Walmart has really reinvented itself over the last 10 years as a kind of omni-channel powerhouse. It's very strong digital capabilities. And this is one of the things why I think the dollar stores have been challenged. They haven't invested in much in technology. If you want to stay at home and have some items delivered to your home, you're a member of Walmart Plus, no problem. We'll get it to your house the next day. The dollar stores can't do that. So they were losing some of that sort of convenience aspect. But I do think that when you talk about trade down, to me, it's really more about making smaller purchases. So if people are feeling strained, you're going to maybe don't buy a full gallon of milk because some of it might go bad. So you're buying a half gallon. Or instead of going to the grocery store or Walmart and buying $100 worth of groceries, I just want to buy for the next 2 meals. So I spend $20 just because I don't want to buy things that could go bad. I'm feeling a little bit uneasy and spending $100. It makes me nervous. So that's where you start to see some of this trade in, trade down to the dollar stores is people shifting to smaller basket purchases. And that's a behavior change. And sometimes it can be driven by job loss. But also, I think in this case, what we're seeing today is just more of a psychology change. Like people are feeling a little more uneasy about the economy. And so their mentality is I should be spending less or making smaller purchases.
Does this uncertainty we're seeing in the marketplace, which sounds like was picked up a lot in your mattress indicator, putting pressure on the story that has carried markets for so long, which is the idea of the resilient consumer, is that in jeopardy?
I think so. I mean, it's obviously murky right now. And look, of course, I'm biased because this mattress survey is proprietary, but it's done this for a long time. And we saw mattress sales roll really hard in March of 2022. And that was like the first pop of the stay-at-home bubble. And then everything in the months to come, big ticket wise, goods wise, got weak. I think what I'm observing in my space is I think that consumers are pausing or holding off on these bigger ticket purchases right now. And big ticket could be a pretty wide net, $80,000 mattress or $1,000 refrigerator. I don't cover Lululemon, but they were out last night. They were talking about some consumer choppiness. So maybe it applies to $100 yoga pants. But what I am seeing that not everything I cover is big ticket. So if I talk to like some car wash operators, for example, which I've done this week, car wash, well, there's a subscription element to car wash now. There's also very much pay per wash retail. That's hyper discretionary. That's not weak right now. That's actually reasonably good. And so you almost tend to think like, that's why it's less about job losses, more about consumer psychology right now. It's very easy to hold off on the big ticket stuff, but there's little like affordable luxuries or affordable pleasures, car wash, going out to a reasonably priced meal, going to a movie. I think that stuff seems okay right now. If job losses pick up, we'll stay tuned. But right now, it seems like the smaller ticket stuff is okay. And it's really this step change in big ticket demand.
I feel like we have to address the elephant in the room, just quickly touch on tariffs and tariff risk. Obviously, covering consumer stocks, I would argue they're all exposed from a macro perspective to tariffs and the spillover effects. But which companies or areas that you cover are going to see some, well, let's assume Trump does what he says he's going to do, and China tariffs have already been raised. Andy was talking about that those could even continue to move higher. What are the companies there where they're going to see increases in price and perhaps have to pass those on?
Yeah. So I'll give you some retailers. The first thing I want to say that's been interesting is look at sort of consumer behavior is that within this consumer sentiment data from UMISH or consumer confidence, there's some questions around like, or do you want to buy a large household durable, in other words, a big ticket item? And if yes, like why is it a good time to buy that? And what we're seeing in these metrics is that the anticipation of prices are likely to go higher. It's hitting multi-decade highs. So the consumer seems to be much more aware right now in the second Trump administration that tariffs will result in higher prices. And it goes back to like January was actually pretty good for mattresses and other big ticket areas. And I think it's almost like maybe there's some demand pull forward. And the scary thing is that there could still be some of that, even though things are weak. Tariffs will be pretty broad-based for my space, particularly with 20% on China. One company that would be uniquely impacted would be Best Buy. And while they are not a direct importer of consumer electronics out of China, the vast majority of their suppliers have goods that come out of China. Just think about Apple iPhones. And if I think about someone like Dollar Tree, they're sourcing like plastic forks or candles or something like that, cheap eyewear. They could get that from China and trying to sell it for $1.25. Those items that for Dollar Tree over time could move to other countries. They're not super sophisticated. When you think about Best Buy and consumer electronics, these plants that are making semiconductor chips or the OEMs putting together the iPhone, there's a lot of technology and a lot of skill that goes in those. So the Best Buy's message has been that you can't really move out of China quickly. And so I do think consumer electronics are one area. Appliances would be another area where there is some concern. And then to your question around who can manage it better, if Stephen I've heard you on our research calls, just talking about larger companies can navigate this higher interest rate environment, can manage tariffs better. That's exactly right. You think about someone like a Walmart, they just have enormous buying power. Suppliers will bend over backwards to keep the Walmart business. Walmart has huge ocean freight contracts, so they can navigate this. You have smaller companies that just don't have that buying power. The suppliers are not going to cover the tariffs as much. It's harder for them to move out of China and find new suppliers. So it's really the big companies, the Walmarts and the Home Depots of the world, even though they have tariff exposure, should be able to navigate this better. And then you have other companies like a Best Buy where they'll just have to pass through prices because there's nothing they could do if these 20% tariffs stick on China. And by the way, the second largest country for products for Best Buy is Mexico. A lot of TV production that comes out of Mexico now. So that's where they're pretty uniquely exposed.
So this is likely going to continue this bifurcation that we're seeing in earnings between large and small, even within industries.
I think so. Yeah, it's been small. It's been large cap has been in favor, small cap not. It feels like tariff could even put gasoline on that fire. And maybe it's ultimately, if there's a recession and rates come down, then small caps will finally bounce back. But right now, it feels like the larger companies will continue to outperform.
So, Peter, you speak with a lot of institutional investors that are investing in this space and have to allocate money. And like you said, there's been this persistent bifurcation in all of these different consumer spaces. What is current institutional investor sentiment around the space? What are they looking for? Certainly, expectations are low for areas that have been underperforming. And if we get some hint of good news, you certainly could see a big pop in some of these names. So what are the conversations you're having with clients?
I think peak uncertainty is the best way I can describe it. I think even just what's going to happen next week on April 2nd, will a lot of these tariffs officially kick in? So I think it's a very challenging time for my clients to make investment decisions. And so I think a lot of people have been working through risk management and just they own what they own. And we do get questions on what are your favorite ideas? Because I think a lot of people are at a loss. What is safe to buy? And so we like something like an Ollie's, I think is super interesting. They're a closeout retailer. They would get some trade down, like tariffs just create supply chain chaos. And so if you're closed out, you're going to get a lot more goods. And so we've got a few names that we asked them, what do you like? We recommend. So Ollie's being one, Tractor Supplies being another. And then I was in Europe last week too, which I should mention. So I haven't been to Europe for a couple of years, but I was over there meeting with investors, and it was fascinating for me because it was really almost like, okay, we know you're a hardlines and broadlines analyst, but let's talk about the consumer and the U.S. economy for 30 minutes because they were also curious on what's going on. And I think if you're European, you're trying to figure out what's going on in the U.S., you just don't know. And you don't think that Peter Keith at Piper Sandler is going to know any better. But you give me some data points. What do you like? I guess as I'm thinking too, what's been fascinating, just going to this mattress survey, is we do this monthly. Some people say, why monthly seems so frequent? Why would you do it? Why not quarterly? And I've always believed mattress sales can change so much. But we're getting stuff now. Okay, well, how was the first half of March? Or how has the last week been? So those have been some questions like, is it still weak in mattress land, or are we starting to stabilize or perk up a little bit? The nearer term questions have only picked up. And as far as we could tell, at least through mid-March right now, that those big ticket trends like mattresses were still pretty challenged.
Do you think we just got into spring and you tend to get, as the seasons change, certainly in the northern part of the States, you tend to see a lot of sales coming into April, et cetera, and Memorial Day. Do you think companies are going to try to maintain or grow market share by offering a lot of sales, or you think that's going to be difficult in a backdrop where tariffs could be a risk, or maybe they don't know yet?
It's a great question because the three of us are in the Northeast, and so it's going to be, I think, 75 degrees tomorrow. And so it feels like we're starting to see the early signs of spring, and weather can be a major factor on my space to drive demand. So certainly if we're not big ticket and the weather's been cold and snowy and unfavorable, like that just exacerbates weak demand. So you could see demand actually accelerate quite a bit just if the weather's warmer year on year. All of a sudden, like your April same store sales look really good because people are out buying patio furniture or mulch or grills. But in terms of the promotional cadence, I think companies will start to lean in. We have seen gross margins are been relatively stable to positive. Companies are still seeing benefits from lower freight costs. And I just keep seeing them, not transportation analysts, but I keep seeing these headlines that freight costs from Asia to like Los Angeles could cost continue to crash. So I think if you're getting those lower freight costs, which a lot of this big ticket stuff that's imported, the shipping is maybe 10 to 12% of sales can be pretty sizable. The companies will use that as an opportunity to promote. So I think on the big ticket seasonal stuff, you will see pretty attractive promotions here as we start to get into the warmer months.
Yeah, and Stephen and I both like to cook. And Stephen's big into barbecue. And I know, Stephen, you already have one of those electric smokers.
Yes, I will be smoking some pork this weekend.
Yeah. I've been eyeing one of those Traegers. So hopefully maybe I'll find a deal this year. And I keep kicking it off every year, but maybe we're far enough from the spike in demand we saw during COVID to maybe get a deal.
You need to hurry before tariffs.
I'll just mention real quickly, I actually have a Traeger. That's a stock I cover. So for you and for anyone that's listening, these 3-day weekends have become very promotional for whether it's furniture, mattresses, but also Traeger. So the time to buy it would be going into Memorial Day weekend. They were the epitome of that stay-at-home bubble, and then the sales have been quite challenged. They've seen some stabilization the last couple of quarters, but certainly that's a big ticket item. So I don't think they'd be immune. And that's a good example of a company that imports a lot from China, should have lower freight costs, probably leans in on promotions for Memorial Day weekend.
Speaking of sales, we were just talking about institutional investors and how they're positioning. A big story this year has been this degrossing idea. Uncertainty has caused investors to get more defensive. Speaking to clients in a space that is really a microcosm for the broader call, are people chomping at the bit to get ahead of a recovery, or is it let's stay more defensive, let's continue to be cautious within the space?
I think that there is certainly a move towards more and more with caution. We saw like all of those discount retailers, dollar stores, even just yesterday, all had a really strong day. And we're going to question that what's going on. It's a rotation to, I can call it defensive growth. So that's more of a real-time data point. But I do think investors right now, even if they are getting defensive, they're still trying to they still want to own something that maybe is just more bigger ticket, more discretionary. Let me lean towards something that's higher quality. Because look, if tariffs go away, these stocks in the market could rally back, and people don't want to be caught flat-footed where they're overly defensive. But there's certainly feels like a shift to more defensive positioning, but also not throwing in the towel on some of these bigger ticket names. Just let's lean higher quality, like Home Depot is a perfect example of that. Piper Sandler, which has now rebranded itself to Somni Group, that's one I like a lot. It's a very high quality company, just bought mattress firms, so they're a huge power player with enormous synergies over the next couple of years. It's names like that seem to actually be holding in reasonably well despite that big ticket exposure.
So you're saying despite the reality of investors were forced to degross, that was pressed upon us, there's still underneath the surface optimistic sentiment of opportunities ahead. Even after a lot of these same themes have played out to different degrees pretty consistently over the past couple of years. Sounds like you're saying a lot of the uncertainty we're seeing today from an investor standpoint is, okay, well, that may pass.
Yeah, because uncertainty is the key. Maybe you're uncertain with a slight negative bias, so that's where you're rotating more defensive growth. But no one has full certainty on a recession or no recession, so it's still a diversified hybrid approach. And that's where, like I said, something like a Home Depot, which I'm just checking, is now down about 7% year to date, or Somni Group that I mentioned earlier is actually up 2%. Like, you would think those are names that would be getting killed, but they're hanging in there because I think there is an element. I'm going to own big ticket. Let's rotate to higher quality, because those names will participate if tariffs get pulled or consumer sentiment bounces back.
Yeah, then there's the aspect, obviously there's concern around a recession and growth fear, and the next phase of that sequence is usually rates starting to come down. And certainly if we saw some higher unemployment data in the coming months or quarters, that would certainly, in my view, be a catalyst to get rates down and change the tone of the Fed to being much more dovish. So I think we've seen these stop and start periods over the last year or so where investors got really excited. The Fed's going to be cutting a lot and the 10-year is going to be coming down, and housing is going to start to see some relief. And I think we're going to see that again. We're kind of, in a way, setting ourselves up for that in the not too distant future. I wouldn't be surprised if those, we call them early cyclicals or rate sensitive stocks, that even if we did see employment starting to weaken and that coincided with lower interest rates, that would probably be an area that I think people would get more positive on and rotate into assuming that, again, the economy is not falling off a cliff, but it's just slowing and gradually deteriorating? Because I think most would expect, okay, look, we're sowing the seeds now of some better outcomes later in 25 or maybe into 2026. That sentiment and opportunity, I think, is going to continue to be on investors' minds thinking ahead.
Yeah, I mean, I think you just encapsulated my investment view on Home Depot and Lowe's for this year, which feels like a challenged first half, maybe some risk to estimates, or we'll say same for sales estimates. Like the way the guidance and self-ed number, they were all placed in late February when weather was being the excuse. It's becoming clear that there's more than weather. So see pressure in the first half, consumer continues to slow. I don't know if we go to recession, but yes, in that environment, perhaps rates continue to come down. And when you think about Home Depot, this has this natural historic relationship. We call it an inverse relationship where, the PE valuation has an inverse relationship with the 30-year mortgage rate. So you could see estimates coming down, the rates coming down, and Home Depot's multiple going higher, and ultimately maybe helping the stock start to outperform. So that is one we have a buy rating on it because we like the potential setup in the back half of this year with continuation into 2026.
Makes sense. That's why they call it a business cycle. This was awesome. Thank you, Peter, Stephen. It's always great to connect the dots with fundamental analysts such as yourself for us macro folks, because like you said at the start of this call, we look at everything from a top down and don't always get all the granular details on the bottom up that could really help shape the picture. So this was super helpful for us, and hopefully our listeners enjoyed the complement of a top down and bottom up approach on the consumer space.
Thank you very much for having me.
Thanks for tuning in to today's episode of What's Next for Markets. Please remember to check out the episode notes on our website, what'snextformarkets.com, for charts related to today's show.
We hope you enjoyed today's episode of What's Next for Markets. You can subscribe to the show on Apple, Spotify, YouTube, or wherever you get your podcasts. Be sure to follow Michael on X at Michael Cantro. If you like the show, please let us know by leaving a positive review. The preceding commentary is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state. You should not consider this as a substitute for these services. Piper Sandler does and seeks to do business with companies covered in its research commentary or coverage. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this commentary. Investors should consider this commentary as only a single factor in making their investment decisions. For full disclosure information, visit www.pipersandler.com/researchdisclosures.